Starting your financial journey early is like planting a money tree that can grow into a financial forest of possibilities. Imagine this. By investing just $400 each month with an 8% return, you could end up with a respectable $1.73 million when you retire. The earlier you start investing, the better. Starting at 25 could make you a millionaire by retirement. Starting at 40 could leave you with less than $300,000. Now, this isn't complicated stuff, and you've probably heard it before, but it's still the best-kept secret to financial success. Today, we're diving deep into the world of investments and financial strategies for anyone looking to secure their financial future. Welcome to the Finance Virtuoso Channel, where we talk about all things finance. If you're seeking a daily dose of valuable information on money, business, investments, and savings, be sure to click the notification bell and hit the subscribe button now. If you're ready to discover the top 10 assets to invest in while building wealth, then let's jump right into our first stop. Number 1. Education. Your 20s are a prime time for learning. Research shows that it's the easiest period to gain new knowledge. So, consider investing in further education during this period. Education can pave the way for career success. However, it's important to realize that not all learning is equally valuable. Be cautious, as some learning might be more of a hobby and not easily monetizable. If you're thinking about investing in education, start by exploring careers that align with your interests and have a potential for success. This is also an ideal time to boost your financial literacy. Number 2. Startup business. Investing in a startup business when you're young can be a game changer. Why? Because the potential returns are unlimited. With a business, you have the opportunity to earn as much as you can. And the return on investment, or ROI, can be incredible. You don't necessarily have to start a business from scratch. You can invest in other people's businesses in exchange for a share of their company. For instance, you could become an angel investor. In this role, you can use convertible notes, which can turn into a loan under specific conditions. Another approach is crowdfunding. Many crowdfunding platforms showcase promising startups with high potential. Before investing, thoroughly research the founder and understand the company's story. Focus on companies with compelling narratives and founders who have relevant education, experience, or training in the business industry. Alternatively, you can work with a venture capital fund. Becoming an accredited investor allows you to participate in venture capitalism. Keep in mind that these funds often require a minimum investment and have strict eligibility criteria. Number 3. Growth stocks and dividend stocks. Your 20s and 30s are a prime time to take calculated risks, as you have time to bounce back from potential losses. Investing in stocks presents an excellent opportunity to allocate some of your money into a high-risk, high-reward venture. Growth stocks are stocks expected to grow at a significantly faster rate than the industry average. They typically generate more consistent positive cash flows and revenues compared to their peers. On the other hand, dividend stocks belong to financially stable and mature companies, meaning their share prices are less volatile than growth stocks. It's wise to include dividend stocks in your portfolio at a young age. They offer a reliable income stream over an extended period, provided the companies continue to perform well. Number 4. Real estate. Real estate is a solid choice for investors. There's usually a shortage of housing, so real estate values tend to go up. Start by buying your own home to save on rent. Once you own a home, you can think about investing in other properties like apartments, offices, or houses. If you can't buy property directly, consider crowdfunding. You can invest as little as $500 and your money joins forces with others to invest in real estate. These investments are called real estate investment trusts, or REITs. Number 5. Index funds. Think of index funds as a basket filled with a variety of investments like stocks. They can be an excellent choice for growing your money, especially if you're not a financial expert. Here's why. Index funds often mimic the performance of a big group of companies, like those in the S&P 500. On average, these funds tend to grow about 10% each year, which is pretty good. To make your investment even safer, you can mix in some bonds, which are more stable but have lower returns. Experts usually suggest having about 10 to 20% of your investments in bonds. Now, there's something new called crypto index funds. They can be promising, with returns ranging from 10% to 15%. But remember, higher returns often mean more risk. The cool thing about index funds is they don't have a lot of fees, which is a good thing. The less money you spend on fees, the more you keep for yourself. Also, be sure to watch out for taxes when you buy and sell these funds. Number 6. Exchange-traded funds or ETFs. Now let's talk about ETFs, which are quite similar to the index funds we discussed earlier. ETFs are like baskets filled with various assets such as stocks, bonds, and even commodities like gold. They operate much like stocks, meaning investors can buy and sell shares on an exchange. Their flexibility makes them handy for investing in broad market indices like the S&P 500, specific sectors such as technology or health, and even subsectors like social media or robotics. An example of an ETF is the Invesco QQQ Trust, which tracks the Nasdaq 100 index. This ETF offers broad exposure to the tech sector by tracking the performance of 100 large-cap non-financial companies listed on the Nasdaq exchange. Number 7. Treasury Bills. Investing in Treasury Bills is a smart move for investors of all ages, but it's especially advantageous when you're young. Treasury Bills are short-term government-backed debts used to fund government spending and manage the money supply. They come in 3 options: 90 days, 182 days, and 364 days. No matter your age, you have financial obligations like tuition, rent, or professional exams. You can easily put your available funds into Treasury Bills and cash out when the bills mature. This aligns with the concept of asset and liability matching, where you invest in an asset to cover a future liability. The key benefit is that Treasury Bills are entirely risk-free, so your returns are guaranteed unlike other investments. Plus, the returns are quite decent, making them a solid choice. Number 8. Annuities. An annuity is a contractual agreement entered into with an insurance company. In this contract, the company promises to provide you with periodic payments, starting either immediately or in the future. You can buy an annuity with a single payment or a series of premiums. Some annuity contracts serve as a way to save for retirement, while others convert your savings into a steady stream of retirement income. Some annuities do both. If you use an annuity to save and the payout starts later, it's called a deferred annuity. If you want income right away, it's an immediate annuity. The most common annuity types are fixed and variable, with a hybrid known as an index annuity, also called an equity index annuity or fixed index annuity. Annuities are often considered for retirement planning, with the added benefit of tax deferral. However, they come with various fees and expenses, including surrender charges, mortality and expense risk charges, and administrative fees. Annuities can also have high commissions, sometimes exceeding 7%. Number 9. Commodities. In economics, a commodity is a tradable economic good, often a resource that's essentially interchangeable. In simpler terms, it means that the market treats instances of the same good as equivalent regardless of their source. There are several ways to invest in commodities. Firstly, you can purchase various amounts of physical raw commodities, like precious metal bullion. Alternatively, you can invest through futures contracts or exchange-traded products, or ETPs, that directly track specific commodity indices. These are usually complex and highly volatile investments recommended mainly for experienced investors. Another approach is investing in mutual funds that focus on businesses related to commodities. For example, an oil and gas fund might hold stocks from companies involved in energy exploration, refining, storage, and distribution. Investing in commodities offers portfolio diversification, the potential for returns, and a hedge against inflation. Commodities have historically performed well during periods of inflation, making them valuable assets to consider. And lastly, number 10, cryptocurrencies and initial coin offerings. Cryptocurrencies and ICOs have recently gained attention, even from traditional investors. With over 1,000 different cryptocurrencies and billions raised in ICO funding, these rapidly evolving markets are enticing for investors. However, understanding these complex investment products and evaluating the risk levels can be challenging for individual investors. What's evident is that they offer potentially high returns, ranging from 12% to as much as 200%. Some ICOs have delivered extraordinary returns. For instance, OTA had a return on investment of 13,000 times. This means that if you have invested just $1 when it launched, you could have made $13,000. In conclusion, these top 10 investment options offer a world of financial possibilities, whether you're just starting your journey or well on your way. Remember, your financial future is in your hands, and the choices you make today can shape the life you lead tomorrow. Let's talk more in the comments below. And if you haven't yet, give this video a thumbs up and share it with your financially virtuous friends. Until next time, may your investments grow and your financial dreams come true.